Hi everyone, Don Singletary. I suppose you've heard the old adage that the whole is equal to more than the sum of its parts. Well, today we're going to select a charting method, Candlesticks, and a trade indicator, MACD, and you'll see what a powerful combination they make when we combine the two to try and get more accurate buy and sell signals. It's a fair question. I get asked a lot, why use candlesticks instead of a bar chart or other type of charting? Well, I like the candlesticks for one good reason, and that is it assembles the information in a faster form to read visually than the other types of charting like bar charts. I also use the MACD indicator for the same reason, a simple, fast way to convert the data into a form that your eye can take in just an instant. They deliver a faster, more accurate symbol for your brain to process than any page of text and math could ever do. In some ways, it's similar to a fighter jet pilot's heads-up display for targeting. Now, I'm going to back up and slow this down a little bit so you can follow along what indicators on this candlestick and MACD combination we got that form the buy signal. I listed them over on the right side of the screen. The first thing was a very high spike in volume, and at the same time, this long white upward candlestick. They both indicate increased momentum, as does the MACD down below. The green line over the red line is bullish, and the fact that the MACD is over the zero line as this happens. Had it been under, different story. But the MACD is over the zero line. That's positive or bullish. One other thing, you can see the distance right under the buy signal. You can see the distance between the green line over the red line is increasing. This suggests a momentum is increasing also, which means there'll probably be more upside. You can rewind and go over that again if you need to. But more importantly, right now, I want to tell you something. Those are the four reasons we got the buy signal, but there's a fifth reason that really locks it all together, and that's what I want to show you now. I've talked about in an earlier video when you're preparing to trade for the day, you need some type of service to tell you when the major reports and news events may happen during that day. This is one I use sometimes from CNBC. And you can see that 8:30 on this particular morning, and remember, that's the time we got that upward spike, was a jobs report due out by the government. They were expecting 180,000 new jobs to be created. It turned out to be 240,000, which was 30% more than they thought. Now, I read this an hour or two before the market ever opened, so at 8:30, I was watching to see what might happen. And with a surprise to the upside, big time, it was the fifth thing I needed to be able to pull the trigger for that buy signal. Now, this is a new chart, a brand new day, brand new indicator, and it's going to be very similar to the one we used in the last illustration. You see the market opens at 9:30, and we have a high vertical gray bar, lots of good opening, and 3 5-minute bullish candlesticks in a row. Now, I probably would have bought into this after the market showed me that I wasn't getting a fake opening at 9:30, so I'm over here at about 9:35 to 9:40, and I probably would have bought in around 84.05 to 84.10, somewhere in this area here. And you can see the momentum continues for quite a while, but then up here, these two doji candlesticks here indicate the undecided traders have taken over the market, perhaps a little bearish in the next one. And the pattern we see here is one where the momentum, these two lines down here, the red and green, are definitely coming back together. And that's a good time to, if you traded one contract, to go ahead and take the exit at around 84.15 or 84.17, somewhere in that area. So we could have made about $20 to $25 on this trade, taking a piece out of this strong opening in the market. Of course, trading two contracts would have been double that, and so on. Probably made a good decision because the red and green lines came back together here, and then the difference goes below the zero line, not the red and green indicators themselves. But actually, looking at this chart in its current condition here, I don't see much enthusiasm for either the bearish or the bullish side. There's an old rule of thumb, and there are plenty of exceptions to this rule, that the best trading is the first hour and the last hour of the market. And it's not always true, but you do get a lot of action at the beginning of a market, especially if there's some economic reports in the wing. This next morning opening, I'm going to show you something a little bit unusual. I talked about reading the reports in the morning to find out what the news in the day may bring, but this is clearly a case of an unannounced something that boosts the market way up. Let me show you exactly what I mean. Okay, let me set the stage for you here. The NASDAQ100 Micro Emini Candlesticks 5 minutes, and you can't see it yet, but the MACD that I always use is in the bottom pane. The market opens at 9:30. An event happens completely unexpected, unannounced, and the NASDAQ 100 shoots up 65 points or $130 in value in less than 5 minutes. Now, I'm going to talk to you about what you can use with the trade indicators in a trade you may or may not have done. You decide. Now, I had read my morning brief and nothing was scheduled at 9:30, so I quickly turned to the financial channels on my iPad, and neither the Fox Business or CNBC had anything about it for a full 10 minutes, but the president had tweeted about a positive outcome for some Chinese trade negotiations. This is mid-December 2019. And sometimes these are rumors and the market will go right back down. But on this particular time, it seemed to stick. So about 15 minutes later, there was an opportunity here for a trade. Now, I had this latency. It was 10 or 15 minutes before I found out from the news why the market had gone up. I wasn't going to go into the market if I don't know why it's moving. That would have been too risky for my blood anyway. Maybe you're different. But anyway, I got to buy at about 84.50. Now, once you're in, the problem becomes immediately when do you get out and how much profit do you take? So let's talk about how you can make that decision in this particular example. I'm going to take this opportunity to talk to you about something I've covered in the other videos extensively, and that's your reward-risk ratio. If you have it 2-to-1 and you decide you'll risk $50 on the trade trying to make $100, that's all fine and good. But you can't really tell the market how much money you want to make because it doesn't listen and doesn't care. It's completely impersonal, of course. So we have to go by the signals that we get. Now we're in at 84.50 and the market goes up. But if you look up top here, it starts to flatten out up top. At the same time, the momentum indicators and your MACD down below, both the vertical green lines down there and the green and red line are coming back together. And all this means that that great rise in the market is losing momentum, and it may do it very fast. So you got to scramble to take some money. Now, there's always the chance the moment you exit, the market continues to go up, and you just live with that. That's part of day trading. It's part of any kind of trading, really. So here we look at the indicators, and we form an idea about when we might want to exit. About 99% of traders are going to get out somewhere in that red circle at the top. If you make it out at anything over 84.80, that makes you the pro from Dover, because we're always going to judge ourselves a few minutes later with the genius of hindsight. I shoulda, woulda, coulda, and you know, hope is not a strategy, so we can't do that. I have an entire chapter in the book, and it's about the psychology of trading. And no matter when you decide to get out in a trade such as this one, you're always going to second guess yourself and think, how could I have done it better? And it doesn't matter what decision you make, you're going to have an inclination to always do that. So you've got to remember to be nice to yourself. Now this is a brand new chart here. What isn't written on the chart is that it's a Friday, and you can see from 9:30 in the morning till 4 in the afternoon. Over early in the day, you see a lot of volatility. Even before the market opens, it swings down wildly and then swings up wildly at 9:30 when it comes back. Now I want to give you a little bit of a test here. First, I want to refresh your memory a little bit of where that zero line is in your MACD indicator. Now, normally, if we're having an up day, we won't be selling anything. And normally, if we're having a down day and below that zero line, we won't be buying anything. But when we have a signal that's above the zero line and the green line goes over the red line, that is definitely a buy signal. And that particular point on this chart is right here. Now notice just a few minutes earlier, the green line was above the red line. However, this happened below the zero line, so I did not consider it a buy signal. Now, I'm not saying you can't use it as a buy signal. I'm just saying it's safer if the green line over the red line happens above the zero line. You have a much safer trade than if it had been below. So I waited until I had that crossover. While we're here and we have this example in front of us, let's take a look at a few other clues you can derive from candlesticks in the MACD. The vertical gray lines in the middle of the screen are the daily volume, and that volume is in those 5-minute increments just like the candlesticks. Now you can see in the early morning from say 8:30 up until about noon, we had pretty good volume. It was up and down, and then it flattens out for most of the afternoon, except right at the close of the day. Now, another thing happened too. The length of the candlesticks in the earlier part of the day was much longer, indicating more volatility. And then, this is a Friday afternoon, things got really dull, as often happens on a Friday. And the candlesticks become shorter and shorter and shorter, and they stay that way, and there's really no volatility for the rest of the day. This chart we've just had here is a great example of how you can learn to read the candlesticks and the MACD and use the two together to try to get some reliable trading signals. There'll always be some false ones, and you'll always have losing trades. It's just part of the game. But learning to put them together. Now, a lot of people already familiar with candlesticks will know they have 60 or so, I call them made-up indicators, symbols of combinations of candlesticks like the abandoned baby and the 3 white crows and the hammer and all these things. But I prefer the method that we've used in this video, where you learn to intelligently look at what's happening to the market and see by the length of the candlesticks and their relationship to the MACD. Going to be posting a lot more videos like this one where you can practice learning to read the charts. So I hope you'll subscribe to the channel, the Day Trading Micro Futures channel here on YouTube. And I hope you enjoyed the video today. I'm Don Singletary. I hope every day is a payday for you. And thank you.